Hi everyone. So this video is basically to discuss about the adjustments related to the non-directional option selling strategies, which is in this case is a Strangle strategy. So this one regarding this, I've shared a reel on Instagram since many of you have commented regarding the full video. Here it is. So basically I have deployed around 1 week before or maybe like 3-4 days before. I've created this Strangle, which is for the expiry of 25th April in Nifty. So this is the payoff chart, but it was good in the last 2 days. But since we had sharp fall that happened in Nifty because of the war announcement and all, but because of that, I'm expecting the correction has happened. But because of that, what happened? The situation slightly got worse, wherein the Strangle is slightly getting into loss-making zone. It still did not get into loss-making zone, but as of last trading session, which is on Tuesday. So here, if you see, on Tuesday, the loss was around 275 rupees. If I just leave it like this, then what I saw is Wednesday is anyways holiday. By Thursday, in case if the market makes a gap down opening of 1%, then my loss will be somewhere close to 7,000 rupees, which is slightly a bigger risk. At that point of time also, we can make some adjustments and bring back into profits. But I generally do not wait too long to make the adjustments. I will be safer before itself. I'll try to make the adjustments before even getting into bigger losses. So what I have done in the last trading session is, I was like, in case if the market makes a gap down opening on Thursday by 1%, I don't want to get this much of a loss. Then we usually have different techniques. Like usually in case of option selling strategies, there is something called shifting adjustment. There is something called this pyramid adjustment, and also there is something called averaging and extension, etc. But this one was completely different, wherein which I tried recently. So if you see, I did not adjust using the same 25th expiry. Rather, I have adjusted this position using 18th expiry, which is also falling on next, which is Thursday. So luckily it happened that whatever the next trading session was there, we luckily got an expiry on that particular day. So what I have done is, forget about this. So if you just look at these expiries, let me refresh it. So if you just look at the adjustment alone, which is just for 1 day. So basically I've done the adjustment only for 1 day because I'm just worried about the upcoming 1 day, 18th of April. Now here, this is the current market price. If the price goes down by 1%, at the end of the day on 18th of April, I'll be making somewhere close to 12,000 rupees. If it is going down by, let's say, 0.9 or 0.8, etc., then the profit can be slightly higher or lower depending upon where it is getting expired. But my main problem is till 1%, I need to be profitable. Now, if I combine this strategy along with my existing strategy, now it will look something like this. It might look a little bit weird, but it is just only for 1 day. So nothing much to worry about. So now what happens by tomorrow on 18th of April, if the market expires flat, let's say, then I'll be in profit of 1,600. My problem is on the downside. So if the market goes downside by 0.5, I don't have any loss. But if the market goes down by 1%, then I'll be in a profit of 6,000 rupees. If I have not made this adjustment, then my loss would have been negative 6,000, 6,700. Because I made this adjustment, around 12,000 rupees of a profit we got, and that net ended up in 6,000 rupees of a profit. It's just loading, just a minute. Today Sensible is too slow. Even when I was teaching with the students, it was very slow. It is taking too much of a time. Yeah, this is the situation. Now, coming to what you learn from this particular thing is, there is one concept of butterfly strategy. The butterfly strategy you can find in the previous video in YouTube channel, which I recorded 1 year ago. I was not very active on YouTube. Maybe if you want me to get active, let me know in the comments what are the videos that you want me to make. If it's too basic, maybe I might not be able to make. But if you want to learn anything in specific, you let me know in the comments. So the point is here, this is a directional butterfly. This is a bearish butterfly because I was worried on the downside. I wanted to have some profitable range around 1% of the range. Now this one, I was risking only 2,450 for a profit of 17,500. Even let's assume that we got around 10,000 rupees profit, which is also a decent one. So this one, I will not be going to exit tomorrow morning, which is on 18th of April. So this I am recording on 17th of April. So on 18th of April till 3:30, I'll be holding this position without exiting because I'm ready to take 2,450 loss. But at any point of time, if the market comes to this particular range, I will be getting the profit as mentioned here. So this one, how you will design it, you basically have to, wherever I'm expecting the markets to fall, that particular level, in this case, it is around 21,950. I sold, let's say, 8 lots, 21,950 call option, and 21,850 and 21,050, which is 100 points of difference from the sell strike. I bought 4 strikes and I bought 4 strikes, which is basically 1:2:1 ratio. The buy legs will be one on in the money and one out of the money, and in the center you will be having 2 sell strikes. Since it is like 4 lots, 4 will be buy on both the sides, 8 will be sell. So that's how this will be designed, and this might require approximately 1.6 to 1.8 lakhs for this, and that's the strategy. If you want, let's say if you're expecting only 0.5% correction, then you may do it, let's say you just find out what is 0.5. Then in that case, if it's coming here, then you will sell 22,050 call option, and then you might buy 100 points above, 100 points below call options. Then you are going to be doing good around this area. So whichever the area that you want, that is where you need to sell the option, and to hedge the position, you need to buy the legs on both the sides. In this way, you will be able to adjust your loss making or potentially loss making non-directional strategy. Let's say by tomorrow, no matter wherever the market expires, I'm not going to make much of a loss. After that, I'll be exiting this with either profit or either 2,000 rupees of a loss. Then let's assume that market went up, for example, by 0.5% or let's say 1%. Then as per this strategy, I'm making 6,000 rupees profit. But as per this adjustment, I would have got 2,500 rupees of a loss. So net would be around 4,000 rupees of a profit. So that is how this will be designed. And there are very high chances that in case if the market recovers tomorrow, and I can easily hold for the upcoming sessions because the weekend is also there. As and when weekend comes, you know what happens. On Monday, as soon as the market opens, if it is anywhere between the center range, you will be getting the maximum profit. And usually whenever I get 80% of the max profit in any non-directional strategy, I'll be taking an exit. So this is the concept of the adjustment which I made. But this concept will work out only if the adjustment need comes one day before the weekly expiry. So in this case, I did it one day before the weekly expiry. That's why it did work out. Otherwise, we may have to go for something else called as a extension or like an averaging kind of an adjustment. So that's it for this video. And let me know if you have any questions in this.